Okay, let's get started this week. This is Middle Class Investor. This is Seth Martin, your host. It is Saturday, about 1:20 p.m. And looking at a chart of the S&P 500, and as you can see, we had a down week right here, although not as down as it otherwise could have been. And not sure what to make of it. I've got a line down here. I mean, there's really two. In my mind, there's two potential scenarios. The market's just going to either drift up here to a new high, and then we're going to see a pretty strong pullback, maybe the end of this entire trend. Who knows? Or the market's going to make its way down here, and then it could carve out what's called an ending diagonal, which would result in higher prices, maybe up around 2,400 sometime next year. So there's no way to know. I mean, I say that all the time, but there is no way to know. My preference would be for the market to drift up here, make a new high, and then that be the end. But I don't really. Nobody asked me what the participants in the market don't necessarily consider what my preferences are in playing out the way the market plays out. So I think it's important to realize that there's a lot of overlap in the market. We had this sideways action last year that resulted in some lower lows, and then we had it was pretty strong, in the first part of the year here through the second quarter coming into summertime. But then ever since then, it's just been really, less than stellar, I would say. And one of the things that we've been talking about, let me zoom in on a different. As you can see here, that one of the things that we've observed is that you have this thrust up down here from the bottom. Let's say to there, or maybe it depends on where you draw this, but let's just draw it. Let's draw it to say here. So you have this big thrust up, and you got this other thrust up it's a little bit less, right? So what I'm kind of expecting is that this continues to thrust up, but it is less than the previous two thrusts to the upside. So what does that mean? It means one, it won't go as far, and two, it won't last as long. So, I've said this before, but maybe we've got a situation where, the market's setting up to roll over regardless of who wins the presidency, whether it's Trump or Clinton. I doubt a third party is going to win, but it could be that Gary Johnson's Libertarian Party or the Constitutional Party or the Green Party could because there's a lot of people looking for a third party this year, and you could have somebody winning the presidency with just a plurality. In other words, not a majority. That's certainly possible this year. Let's take a quick peek at the VIX. The VIX is still very low, as you can see, and as a result, I think that's why you're seeing all this choppiness. There's complacency in the market, but it doesn't seem to be resulting in an upward drift of prices. So there's a little slope here that we're dealing with on the VIX, but for the most part, the VIX is sideways. We've pointed out here that it's been in this range through this area for a long time, since the beginning of the year, and probably you won't see it bust out of this range until we see some sharp sell-off in the S&P and in the financial markets in general. All right, let's look at the 13-week Treasury. There's a lot of talk about the Fed. It's almost nauseating how much talk there is about the Fed. And you can see we had this sharp pullback in rates right before the previous Fed announcement. and then we've had this, they've just rifled right back up. So this happens sometimes where you get the market pulls back like this, and this could very well end up resulting in some price action above this dotted line. And if that is the case, the Fed will be raising rates. Now they may not even raise them until next year, but if we get price action and we're to the point where this line becomes the floor in the market, the Fed will be raising rates, no doubt about it. You can just count on it. Even if the economy is junk, and rolls over really bad, they're more concerned about their reputation than they are the economy. So, to the extent that low interest rates even help the economy, which not sure they do actually, but to the extent they do, they'll be raising rates anyway because their reputation is more important to them than the actual economy. So I think that'll be interesting, and I think probably what'll happen is you'll see a backlash against the Fed. I think you'll start to see a drumbeat in the media about, do we really need the Fed? Is the Fed helpful or harmful to the economy? And there'll be a lot of talk like that, I think. The interesting thing is not many people really even understand what the Fed does, so I don't know how productive that conversation will be, but I think you'll see more and more people talking about whether or not the Fed is even necessary to have, so my opinion is it's not, but again, I'm only one vote, so if the numbers of people start to really accelerate in the it's not necessary camp, then you could see the Fed ending its 100-year history in our lifetimes, which would be kind of exciting. So let's look at the 10-year Treasury. We have seen rates tick up here recently, but as you can see, they're still basically inside the channel. So this run up was pretty steady all the way through here, and it may not be done. You may see a little bit of pullback next week, and then rates continue to climb. I think the stopping point to the upside before we see a pullback is probably in this 2 area, and you could see a pullback back to the channel before it takes off again. But it does look like rates, it is looking like, and we won't know until we get this higher low and then a launch, but it does look like rates have begun to stop going down. And there's a huge drumbeat out there about harming the banks and how negative interest rates would harm the banks. The banks are struggling to make money now, and making interest rates negative would only make things worse for the banks. There's a lot of problem with the European banks, Deutsche Bank primarily, but then they haven't even started talking about the Italian banks, and I think in many ways they're in worse shape. So we got major banking issues around the world right at the end of a business cycle, which usually spells disaster of some sort. So we're gonna stay focused on the S&P 500. I think if we do that, the market will tell us when it's time to leave. And I've gone back to the S&P 500 here because I want to continue to make a point. Sometimes in your 401k, the way the 401ks are structured, if you make a decision to sell, your sell decision is made at the end of the day. So, if we got, let's say this drifted up here, and then we got a big, it probably wouldn't happen this way, but let's say we got something that maybe looked like this, kind of a dragonfly doji, and then something like this, and then all of a sudden we had something like this, And maybe during the middle of the day, let's say right here, you thought, okay, I'm gonna go ahead and step to the side of the market. But what would happen is your order to get out of your 401k and go to cash wouldn't get executed until down here because it's an end of the day kind of transaction. So just be aware of that. I think if you had this kind of candle, you'd probably have to be prepared for it to go all the way down, around 1700 and then bounce up into here and then sell, which is always kind of a risky proposition. I mean, you don't really ever know what kind of bounce you're going to get. That bounce may not happen to your satisfaction for 10, 20 years. I mean, I know that sounds crazy, but that's what happens in markets. If you go back and look at even the S&P 500, if you go back and look at it historically, let's just say all data, and let's go back. Well, even the last financial crisis that we had, if you let's say you made a decision to get out right here at the end of this day, so right there. Well, that was only a few months later. You had to wait about 7 or 8 months before you got your money back. But sometimes you have to wait years. I mean, there's times in the market where, this is a good example. This is 1987, the crash of 87. So, not that there's a great place to get out here, but sometimes you have to look at it like, wow, there's only maybe 3% upside left in the market, but there's this huge potential for downside, which is what happened here. So if you panicked and went ahead and sold right here at the end of this month, this candle month here, then it was, and so your high water mark was up here. It was what, a year and a half later or more, almost 2 years later before you got your money back and then some. So you just have to, sometimes it just makes sense to, when there's risk, risk in the market, significant amount of risk, or there's the reward for the amount of risk is not that high. Sometimes it's just, when you're looking at this and you're going, well, it could get up here to 2250, but man, that's not that much higher. That's only 100 points higher than where we are right now. Maybe you get a bounce next week, go ahead and sell and just wait until you get a pullback, into this 1825 area, or at least reevaluate, what the market is doing at that point. When we do pull back there, because it will pull back there eventually. But sometimes it's just not worth it for that extra 100 points for the amount of risk that exists in the market. And that's the point I'm trying to make here. I would say continue to watch the 10-year Treasury yield. It was up again. It moved pretty substantially last week. Excuse me, I was overcome by a yawn there. It moved pretty substantially last week, as you can see here, and is probably not through. I mean, my guess is, the RSI is still here in the middle of the range. My guess is this is probably going at least to 2, or 1.89 or 1.9 before it stops. And the reason I say that is because this spot right here kind of marks a confluence of trend information right along in here around 2.0. So again, if you're in those bond funds, you might need to reevaluate that. Certainly wouldn't be a buyer of any bond funds right now. If you want to ladder bonds, in other words, if you want to actually go into the market and buy individual bonds, I think that's fine. You can buy a whole different range of durations, from 10s to 7s to 5s to 2s to 1s to 3 months. So that's probably okay. But just going into a bond fund, thinking that you need 40% of your portfolio or something in bonds, I think is a mistake. So, all right, let's switch over and look at the dollar. Here's the dollar. You can see the dollar had a big up week too. Looks like it is through going down, but who knows? I mean, it could stop right here. I mean, this is kind of a bearish looking candle. It depends on what next week's candle looks like, but it could stop here and move back down and retest this area of support. Maybe it's slightly lower low and then rally. So, or it could come back to a higher high and rally. If it comes back to a higher high and rallies, then I think that's probably a good reason to start looking at your bond funds and getting out. All right. Let me put this back over here like that. There we go. That's a little bit better. All right, let's look at gold. Gold sold off pretty sharply this week. Probably based on the dollar. There was a big move in the British pound dollar. And so, gold and all these silver, all these precious metals and stuff had to react accordingly. And I think it's safe to say that gold is going to continue to come down into this area and then likely bounce to new highs and then start going through the corrective process at that point. In other words, this whole move right here from here to here could just be the A move of an ABC that would constitute, say a B wave up off of this huge run up. Let's go back and I'll show you this huge run up. This is a huge move in gold, and so now what you need is you need to work some time off of this trend, which could be for the next several years. I mean, you could have a situation where this is, it's down, then up a little bit, and then down. But that could take, another 2 years. Or more before we got into this zone down here around 700. So, again, I think for gold, I think it matters whether or not you're going to buy the physical gold or if you're just interested in trading gold. If you're just interested in trading gold, you can use futures, of course, which I've got up here on the screen, or you can look at the GLD, which is an ETF, and you can see it looks very similar to the gold price chart, the market spot chart. Let's look at crude oil. Crude oil ran up this week, and we talked about that. We talked that it could run up and actually make a higher high and then roll over and start coming down to this this mid area just below this trend. So let's look at that Great British Pound, and I'll show you the move it had this week. It's pretty substantial. Now it's already bounced back half of it, but you can see this move. That's a big move in the currency market. So what you're seeing is you just saw, the British pound break down to almost parity with the dollar. I mean, it was only 20% away from being parity with the dollar, which is incredible. Well, if you've ever been to England, but everything is so expensive over there. Well, that's because the dollar is weak compared to the British pound. But this looks somewhat complete for the near term. So I don't know if I would get too aggressive with gold to the upside here. I think gold's the British pound, in this case, its play is still to the downside, probably to a parity target. Look at silver. Silver's pretty much the same. Looks very similar to gold, and who knows? You've got this downtrend that started back in 2011 after this huge uptrend, and so far it's broken out. It looks like maybe it's pulling back to test this trend line, and I've got a target in here of just below this wave forward low of around 1570 or so, and then I'm expecting silver to bounce. All right, that's really about it this week. The euro US dollar, we can look at that real quick. It really hasn't been following the pattern as well as I would have liked it to. The interesting thing is you do have this dollar fall kind of setting up. So the euro fall. I keep going to the dollar. The euro, so the euro fell a lot here, and then you basically have a consolidation where buyers and sellers are kind of working off their losses or whatever from this fall right here. So when you have a fall like this and it's in a short period of time, you end up following it up with some chop that lasts a lot longer to just kind of work off the accounts and get everything sorted out. And so a lot of times this pattern will actually flow like this onto down below this trend line into potentially lower lows. All right, that is about it for the week. Again, I'm still fighting this cold or whatever I've got. I've been to the doctor twice. They gave me something. They thought I had pneumonia, but the chest x-ray said no. So anyway, it's just been a battle. I turned 50, and then ever since then, it's been fighting this illness. It's like I don't know. It's like rite of passage or something. All right, everybody, that is it for this week. Really appreciate you coming in and listening to the videos. I hope you're forwarding them and sharing them. We're not far away, I don't think, from some pretty tumultuous times in the market. And I think your friends, relatives, people you know will be better served if they are in a position to take action on doing something with their savings rather than turning on the TV and trying to find answers, after the meltdown has already begun. So I'm hoping that you're sharing it with people, maybe sending them a link. But just going back to this S&P 500 pattern, I don't think there's a whole lot left in this particular move right here. Again, unless it comes down here below and then kind of chops back up. So look for volatility expand after we get up maybe into this area around 2250 and then start to roll over. Look for volatility expand. Look for the chatter and the what's going on and the Fed's awful and just all that talk to increase as this market falls to below these February lows. All right, everybody. Thanks a lot for coming in. Really appreciate you taking time out of your day to learn a little bit about what to do with your money. Of course, these are just recommendations. At the end of the day, you have to make a decision about what to do with your money. So I'm just trying to help you understand some things that are out there in the market that will help you make better decisions. So continue to come in, comment if you like, and we'll see you next time. Take care. Bye-bye.